Welcome to the CoreLogic RP Data Housing Market Update for March 2016. The first 2 months of the year have seen the housing market regain some of the losses recorded over the final quarter of 2015, with capital city dwelling values rising by 0.5% in February, following a 0.9% rise in January to take our hedonic index 1.4% higher over the year to date. The latest figures take the rolling quarterly change in capital city dwelling values to an increase of 1.4%, and the annual change is up slightly from the 7.4% last month to 7.6%. The combination of capital gains and the addition of newly built housing has taken our estimate of the total value of Australia's residential housing stock to $6.5 trillion. Across the individual capital cities, Sydney was the only city where home values were lower over the quarter, down by 0.2%. The largest movements in our capital city index over the past 3 months were in Hobart, which was up by 8.5%, Melbourne values were up by 3.8%, Brisbane showed a 2% rise, and Canberra dwelling values were up by 1.5%. Turning to the annual change in values across the combined capital cities, they're up 7.6%. That's higher than the 7.4% annual rise recorded in January 2016. The annual rate of value growth is well below the recent peak of 11.1% over the 12 months to July 2015, and we're expecting a further moderation in the annual trend rate of growth as the year progresses. Annual growth in detached house values has outperformed units across the combined capital cities. However, over recent months, the gap in performance has narrowed despite the higher supply levels, which are increasingly apparent across some of the inner-city apartment markets. House values have increased by 7.8% over the past year, compared to a 6.2% increase in unit values. The most substantial gap between the performances of houses compared with units is in Melbourne, where house values have recorded an annual increase which is more than double the rate of growth in units, at 11.8% for houses compared with a 5% growth rate for units. Looking at the number of homes being advertised for sale, we can see that residential property listings are continuing to climb. Vendor confidence appears to have risen, with the number of newly advertised properties moving 5.3% higher than at the same time last year. The total number of homes being advertised for sale over the past 4 weeks has risen by a slightly higher 5.7% compared with the same time last year. The highest stock levels are being driven by a sharp rise in Sydney, where total listing numbers are now more than 20% higher compared with a year ago. Total listing numbers have been progressively rising in Perth and also in Darwin. More stock means more choice for buyers, and we may see the average selling time and rate of discounting continue to widen across Sydney, Perth and Darwin as the market rebalances in favour of buyers. Our suite of private treaty metrics remains somewhat mixed, however. The average number of days on market is extremely seasonal, with the latest data to January 2016 showing an expected rise due to longer selling conditions during the Christmas and New Year festive period. Across the combined capital cities, the average days it takes to sell a home was recorded at 64 days compared to 61 days a year ago. Across the individual capital cities, only Melbourne, Adelaide, Hobart and Canberra homes were selling faster than a year ago. If we look at the typical level of vendor discounting, it's recorded at 5.7%, which is exactly the same level as it was a year ago. Vendor discounting levels have increased compared with a year ago in Sydney, in Perth and also in Darwin and Canberra, and are unchanged in Adelaide. The auction market's begun the year with quite healthy clearance rates. After combined capital city auction clearance rates fell as low as 57.3% late last year, they've been recorded at above 70% for 4 consecutive weeks now, falling slightly below 70% over the most recent week. Both Sydney and Melbourne have also recorded clearance rates well above those levels recorded late last year. As the year progresses and auction volumes continue to rise, we anticipate a reduction in clearance rates in line with expected moderations in the rate of capital gain and higher listing numbers. The rate of home value growth in cities continue to slow, and the gap between growth in Melbourne and Sydney home values has widened. Sydney was the only capital city where home values moved lower over the past 3 months. They were down by 0.2%. Over the past year, home values in Sydney have increased by 9.5%, which represents a fairly significant slowdown over recent months after annual value growth peaked at 18.4% in July last year. House values have increased by 9.7% over the past year, compared to an 8.8% rise in unit values. Sydney rental rates have increased by 1.1% for houses and by 3% for units over the past year. With home value growth outpacing rental growth, gross yields have softened from 3.5% and 4.4% a year ago for houses and units respectively to 3.2% and 4.2% currently. While the annual rate of value growth has continued to slow in Sydney, Melbourne's annual value growth has remained relatively steady over the past 3 months, recording an 11.1% rise after moving through a recent peak of growth in September last year when dwelling values are up 14.2%. Although Melbourne's experienced strong recent growth in values, it seems to be benefiting from the fact that it's still very much cheaper to buy a home in comparison with Sydney. Over the past year, house values have increased by 11.8%, which is a significantly greater rate of value growth than the 5% rise for unit values. Rental rates have increased by 2.2% for houses and 1.8% for units over the past year. With value growth outpacing rental growth, rental yields have pushed even lower over the year, falling to 2.9% for houses and 4.0% for units, compared to 3.2% and 4.2% respectively a year ago. Melbourne has the lowest rental yields of any capital city. Home values in Brisbane have increased by 1.8% in February, by 2% over the past 3 months, and are 5.5% higher over the past year. This represents the strongest annual rate of growth for Brisbane home values in 12 months. Looking at the difference between growth in houses and growth in units shows that house values are 5.7% higher over the year compared to unit values, which have increased by 3%. While values have continued to rise in Brisbane over the past year, rental rates have fallen. House rents are 0.7% lower over the past year, and unit rents have fallen by 0.4%. Given that values are rising and rents are falling, gross rental yields have fallen over the past 12 months. Despite lower yields, Brisbane's average gross yield for units is equal highest of any capital city along with Darwin, and house yields are amongst the highest. Rental yields for houses have fallen to 4.2% from 4.5% a year ago, and unit yields have fallen from 5.5% to 5.3%. Adelaide dwelling values increased by 1.9% in February. They were 0.3% higher over the past 3 months and have increased by 2.8% over the past 12 months. The rate of value growth in Adelaide over the past year has been quite soft. In fact, of all the capital cities where values have increased, Adelaide has seen the slowest rate of value growth. Houses in Adelaide have recorded comparatively stronger value growth over the year, increasing by 3% compared to a 0.8% increase in unit values. Adelaide rental rates have fallen over the past 12 months, down by 0.4% for houses and down 0.5% for units. As a result of these rental falls, yields have compressed over the year. A year ago, houses had a gross rental yield of 4.2% and units 4.8%, while yields are currently recorded at 4.1% for houses and 4.7% for units. Dwelling values in Perth fell by 1.1% in February, however they have increased by 0.2% over the past rolling quarter. Over the past 12 months, home values in Perth are 3.1% lower, which is the largest annual fall of any capital city. Since Perth's dwelling values peaked back in December 2014, dwelling values have fallen by a total of 5.7%. Over the past year, house values have recorded a larger value fall than units, with values down by 3.2% and 1.6% respectively. Rents have fallen sharply over the past year, down by 8.3% for houses and 9.3% for units. Given the bigger fall in rents relative to home values, gross rental yields have fallen over the year. House yields have shifted from 4.1% a year ago to 3.8%, and unit yields have fallen from 4.7% to 4.3%. Hobart's housing market has shown a sharp improvement in value growth over the recent months, with values rising 2.9% over the month, 8.5% higher over the past 3 months, and are 6.2% higher over the past 12 months. Hobart's annual rate of home value growth is now the highest it's been since July 2010. Over the past year, unit values have increased by 7.4%, which represents a greater rate of growth than the 6.1% rise in house values. Rental rates for houses in Hobart have fallen by 0.3% over the past year, compared to a 3.1% rise in unit rents. With value growth outpacing rental growth, gross rental yields have fallen for both houses and for units over the past 12 months. A year ago, house and unit yields were recorded at 5.3%. Currently, house yields sit at 5% and unit yields at 5.1%. Darwin home values increased by 0.4% in February. They were 0.3% higher over the past 3 months, but they've fallen by 2.9% over the past 12 months. Based on end-of-month values, Darwin home values are now 6.3% lower than their most recent peak back in July 2014. Over the past year, Darwin house values are 2.6% lower, while unit values have recorded a larger 4.4% fall in values. While home values are falling in Darwin, rental rates are falling at a substantially faster pace. House rents are down by 13.5% over the past year, and unit rents have fallen by 12.2%. Home values across Canberra fell by 0.2% in February, but the trend has been much stronger. Dwelling values were 1.5% higher over the past 3 months and 4.5% higher over the year. Home values in Canberra are showing moderate levels of growth. However, the increase is being driven by houses as opposed to units. Over the past year, house values have increased by 5%, while unit values have fallen by 3.1%. Canberra is the only capital city in which rental growth is currently stronger than it was a year ago, with rents increasing by 1.5% for houses over the past year and by 2.8% for units. Overall, the broad trends in the housing market mask a great deal of diversity from city to city and region to region. Perth and Darwin remain the only capital cities to record a fall in dwelling values over the past 12 months. However, the rate of capital gain in Sydney has slowed substantially since July of last year. The cumulative effect of tighter lending conditions, more expensive mortgage rates, particularly for investors, and lower yields, as well as natural affordability constraints, as well as higher levels of new housing supply, is likely to continue to impact on the Sydney housing market, resulting in a further slowdown over the year. It's also expected that as the year progresses, the rate of home value growth in Melbourne will also slow. However, the slowdown is likely to be more moderate than the slowing in Sydney, at least during 2016. Recent housing market forecasts released by CoreLogic together with Moody's Analytics indicate a continued slowdown in these markets over the remainder of the year. Based on these forecasts, which will be updated monthly, Melbourne's housing market is expected to be the best performing city for capital gains over 2016 before the pace of capital gains starts to fall away to less than 1.5% over 2017. The markets that are forecast to show an improvement in the rate of capital gains are Brisbane, Canberra and Hobart. Outside of the capital cities, we're continuing to see a healthy rebound in housing market conditions across the lifestyle markets. Following a slump in buyer activity and prices between 2008 and 2014, it seems that demand for lifestyle properties and holiday homes is consistently improving, which is pushing prices higher in these regions. On the other hand, regional markets linked to the mining and the resources sector continue to record weak conditions. There may be some tentative signs that these markets are reaching a floor in values and activity. However, there's no indication that values will start to rise in these areas over the foreseeable future. Investor activity in the housing market has continued to soften from the peaks of May last year, when investors accounted for more than half of all new mortgage commitments. Based on the most recent housing finance data, investors now comprise 45% of the value of new mortgages committed to. That's still well above the long-term average though. Growth in investor-related mortgage credit has fallen well below the APRA imposed speed limit of 10% growth per annum. Considering the high volatility in equities and the low returns in safe asset classes like cash and government bonds, it's likely that investment in the housing market will continue to track at higher than average levels despite the mortgage rate premium that investor loans have experienced since August last year. As always, thanks for tuning into the housing market update from CoreLogic RP Data. You can find regularly updated commentary and statistics on the housing market at our website, www.corelogic.com.au.